Two people, same income, same starting point, same year. One buys a rental property, the other opens a brokerage account and puts the same money into index funds. 20 years later, one of them is significantly wealthier, and the answer to which one and why is almost certainly not what you think it is. This debate has been going on in personal finance circles for decades. Real estate investors swear by the tangibility, the leverage, the monthly cash flow. Stock market investors point to simplicity, liquidity, and historical returns. Both sides have passionate advocates, both sides have compelling numbers, and both sides, if you're being honest, are selectively using data to prove a point they already wanted to make. This video is not going to do that. This video is going to run the actual math, side by side, same assumptions, same time horizon, same starting capital, and show you what the numbers really say. Not what a real estate influencer wants you to believe, not what a passive investing evangelist has cherry-picked. The real comparison, with the real variables, and the real answer that most people in this debate conveniently leave out. Buckle up, because the math is genuinely surprising. By the end of this video, you are going to have a clear, honest, apples-to-apples comparison of real estate investing versus stock market investing. You're going to understand the specific conditions under which each one wins, the hidden variables that most comparisons ignore, and, most importantly, what the right answer actually looks like for someone in your situation. No hype, no agenda, just math and the thinking that the math produces. If you're new here, this channel is where serious financial analysis lives. We don't sell courses, we don't have a preferred outcome, and we don't dress up bad arguments in impressive-sounding numbers. We just do the work. Hit subscribe right now and turn on notifications. This is exactly what we do every week. Let's run the numbers. Number 1. Set the stage. The same $50,000. Two completely different paths. To make this comparison honest, we need identical starting conditions. So here's the setup. You have $50,000 to invest. You have a 20-year time horizon. You are going to put this money to work in 2026 and not touch the proceeds until 2046. Now, you use the $50,000 as a 20% down payment on a $250,000 rental property. You take out a mortgage for the remaining $200,000 at a 7% fixed rate over 30 years. The property is in a solid mid-size market. Nothing exotic, nothing speculative. A normal house in a normal city. Thereafter, you invest the same $50,000 into a broad market index fund, something like a total market fund or an S&P 500 fund, and you make no additional contributions. You reinvest all dividends automatically. You don't touch it. Same $50,000, same 20 years. Two completely different journeys. And here's where people make their first mistake in this comparison. They only look at the headline return numbers. They don't look at what's happening underneath those numbers. The costs, the risks, the cash flow mechanics, and the hidden variables that change everything. We're going to look at all of it. Number 2. Run the stock market math first. It's simpler, so let's get it out of the way. The historical average annual return of the U.S. stock market, including dividends, reinvested, is approximately 10% over the long term. Adjusted for inflation, that number drops to around 7%. We're going to use 8% as a realistic middle ground that accounts for some fees and realistic conditions rather than the theoretical best case. $50,000 invested at 8% average annual return for 20 years. The math. 50,000 times 1.08 to the power of 20 equals approximately $233,000. So after 20 years, your index fund investment has grown to roughly $233,000. You put in $50,000 and walked away with $233,000. You didn't fix a single leaking tap. You didn't deal with a single tenant. You didn't lose a single night of sleep over a vacancy. You just let the market do what the market does. Now, let's factor in taxes. If this isn't a taxable account, you'll owe capital gains tax when you sell.
At the long-term capital gains rate of approximately 15% for most investors, your gain of $183,000 gets taxed at 15%, leaving you with roughly $206,000 after tax. If this is in a tax-advantaged account, a Roth IRA for example, you pay $0. So let's call it a range, $206,000 to $233,000 depending on account type. Solid, simple, boring in the best possible way. That's the stock market path. Number 3. Now run the real estate math. And don't skip the boring parts, they're where the truth is. This is where it gets more complicated and more interesting. Your $250,000 property purchased with a $200,000 mortgage at 7% over 30 years. Your monthly mortgage payment, principal and interest, is approximately $1,330. Let's say the property generates $1,800 per month in rental income. That sounds healthy, but before you start celebrating, let's account for the costs that real estate investors who are trying to sell you a course often conveniently round down. Property tax, approximately $250 per month in a mid-cost market. Insurance, approximately $100 per month. Maintenance and repairs. Industry standard is 1% of property value per year. That's $2,500 annually, or roughly $208 per month. And that's conservative. Roofs, HVAC systems, appliances, and plumbing don't read the budget spreadsheet before they break. Vacancy rate. Even in a strong market, budget for 1 month vacant per year. That's 8% vacancy, or the equivalent of $150 per month averaged across the year. Property management. If you self-manage, this is sweat equity, not a financial cost. If you hire a manager, which most out-of-state investors need to, that's typically 8 to 10% of rent. Call it $160 per month. Total monthly expenses excluding mortgage, approximately $868. Monthly cash flow, $1,800 minus $1,330 minus $868 equals negative $398. Wait, negative? Yes. In a significant number of real estate markets in 2026, a property purchased at current prices with current financing will not cash flow positively from day one. This is not a failure of the strategy, it's the reality of buying in a high-price, high-rate environment. And it's a critical variable that real estate promoters often gloss over with projections that assume rents will rise and rates will fall. So in this scenario, you are not collecting passive income, you are subsidizing the property by approximately $400 per month while it, hopefully, appreciates. Number 4. Calculate the real estate outcome after 20 years. All of it. Now, let's look at what the property is worth in 2046. Historical average home appreciation in the U.S. is approximately 4% per year, nominally around 1% real, inflation-adjusted. Using 4%, a $250,000 property after 20 years is worth approximately $548,000. That's your gross asset value. But now subtract what you still owe on the mortgage. After 20 years of payments on a 30-year mortgage at 7%, you've paid down the balance to approximately $152,000. So your equity in the property is $548,000 minus $152,000 equals $396,000 in equity. But we're not done. Let's add back the negative cash flow. At $400 per month for 20 years, you've put an additional $96,000 into the property beyond your down payment. Think of it like this. You didn't just invest $50,000. You invested $50,000 plus $96,000 equals $146,000 total out of pocket. Your return on that $146,000 total investment is $396,000 in equity. That's a gain of $250,000 on $146,000 in 20 years, or roughly 5% annualized on your total capital deployed. But wait, there are 2 more variables that can swing this dramatically in either direction.
The first is leverage. The power of real estate is that you controlled a $250,000 asset with $50,000. The appreciation happened on the full $250,000, not just your down payment.
If we measure return only on the initial $50,000 deposit, not the total cash invested, your $50,000 turned into $396,000 in equity. That's a return of 692%, or roughly 11.2% annualized on initial capital. The second is the sale costs. When you sell that property, you pay realtor commissions, typically 5 to 6% of sale price, or approximately $28,000 to $33,000, closing costs, and potentially capital gains taxes on the profit. Net of a 6% commission and 15% capital gains on the gain above your original purchase price, your after-tax, after-costs proceeds shrink to approximately $310,000 to $330,000. So, the real estate path, total return somewhere between $310,000 and $396,000, depending on how you account for costs and taxes, with a total cash investment of $146,000 over 20 years versus the stock investor's $50,000 total. Number 5. The real comparison. Finally, here's where most comparison videos stop and where the real insight starts. On raw ending equity, real estate wins $310,000 to $396,000 versus $206,000 to $233,000 for stocks. But, and this is the critical but, the real estate investor deployed significantly more capital to get there. They put in $146,000 over 20 years versus the stock investor's $50,000. If the stock investor had invested that same additional $96,000 over time, say $400 per month, the same amount the real estate investor was subsidizing the property by, invested into the same index fund, let's calculate what that produces. $400 per month invested at 8% for 20 years equals approximately $236,000. Add that to the original $50,000, growing to $233,000, and the stock investor's total portfolio is approximately $469,000, before tax, before fees. After capital gains tax on the gains, approximately $390,000 to $420,000. In other words, when you account for all the capital deployed, not just the down payment, the stock market and real estate perform remarkably similarly over 20 years in this scenario. The real estate investor has slightly more or slightly less depending on local market conditions, management costs, and tax situation. Neither one is a landslide. Both strategies, executed well, get you to a similar place over 2 decades. If that seems anticlimactic, hold on, because the real answer isn't in the math, it's in the variables. If you're getting value from this breakdown and you want more of it every week, subscribe to this channel right now and hit the notification bell. This is the kind of analysis we run every single week. No fluff, no agenda, just clear financial thinking. Subscribe before we get to the twist. You're going to want to hear it. Number 6. The variables that actually decide the winner. Here's the truth that the math reveals. The better investment isn't real estate or stocks. It's whichever one you will actually execute consistently in the right market with the right temperament for the right time horizon. Real estate wins in specific conditions, when you buy in a market with strong appreciation and strong rental demand, when you can manage the property efficiently, when you have access to low-cost financing, and when you have the temperament to handle tenants, maintenance, and the occasional nightmare month without panicking and selling at the wrong time. The stock market wins in specific conditions when you can resist the urge to react to volatility, when you maximize tax-advantaged accounts, and when you invest consistently rather than trying to time the market, and when you don't need the money to be liquid for the full investment period. The biggest factor, by far, isn't which asset class you choose. It's whether you stay in the game long enough for compounding to do its work. Most real estate investors don't. Most stock market investors don't either. They sell too early, panic too easily, or let life get in the way. The person who gets rich isn't the one who picked the perfect asset class. It's the one who picked an asset class they understood, stayed consistent for 2 decades, and didn't do anything catastrophically stupid in the middle. The second biggest factor is leverage. Real estate gives you access to leverage, borrowing 80% of the asset value at a fixed rate that stock market investors simply don't have on the same terms. In a rising market, that leverage is enormously powerful. In a flat or falling market, it's the thing that forces distressed sales at the worst possible moment. Which brings us to the variable that nobody wants to talk about: risk. The stock market investor who loses 40% in a downturn can sit tight. The real estate investor who loses rental income, can't cover the mortgage, and has a tenant dispute at the same time cannot always just sit tight. The real world has gravity, and leveraged real estate can feel it more acutely. Number 7. The answer, and it's going to annoy you slightly. The answer is both, ideally, in sequence. Start with index funds. They require the least capital to begin, the least management burden, and they compound silently while you build your income and savings rate. Put money in every month. Automate it. Don't look at it more than quarterly. When you have sufficient capital and cash flow to absorb the costs and the negative cash flow periods, add real estate, not instead of index funds, in addition to them. Use the leverage real estate offers to amplify gains on appreciating markets while your stock portfolio provides liquidity and a non-correlated asset base. The secretly wealthy people who are quietly killing it in 2026 aren't choosing between real estate and stocks. They're using stocks to build capital and real estate to deploy it with leverage. Then they're letting both compound simultaneously for decades. That's not a revolutionary idea. It's just what the math supports when you run it all the way through, which is exactly what we did today. Here's the summary version that you can take into your next decision. Real estate and stocks over a 20-year horizon with consistent execution produce similar outcomes when you account for all the capital deployed. Real estate wins on leverage and tangibility. Stocks win on simplicity, liquidity, and accessibility. The biggest variable isn't the asset class, it's whether you stay consistent and don't do something emotionally driven at the wrong time. Whichever path you choose, start before you feel ready, automate what you can, and measure in decades, not months. And if you can manage both, eventually, the math says you probably should. If this breakdown gave you a clearer picture of how to think about this decision, not just for today, but for the 20 years ahead, do 3 things. Like this video so more people can find it, share it with someone who's caught in the real estate versus stocks debate, and subscribe to this channel with notifications turned on. Every week we do exactly this: run honest numbers, challenge lazy assumptions, and give you the financial clarity that most people aren't getting anywhere else. The subscribe button costs nothing. The thinking it unlocks over time is worth considerably more. We'll see you in the next one.